Hello, my name is Blaine Anderson. I'm a Tech Smart Wealth Advisor and Certified Financial Planner at Vander Wealth Management. I'd like to take a couple of minutes and share with you details regarding an investment vehicle that we are utilizing here at Vander Wealth Management on behalf of clients. This is known as a principal protected market linked note. It is a structured instrument that allows us principal protection while still participating in the upside of the market. I will share with you a few examples of investment vehicles that we've already customized, as well as our rationale for utilizing at this time and our plan for moving forward. Allow me to share my screen. These principal protection market-linked notes have a few components. It's a financial instrument that offers rewards while protecting the initial investment. It also provides a combination of principal protection and potential returns in the future. We also like it for the diversification purposes that we feel it adds to a well-balanced portfolio. Now, a few risks. Number one, the credit risk. This is more relative and applies to the issuer of this particular principal protection market-linked notes. You'll notice that we use a variety of different financial institutions to provide risk mitigation and diversification. It is one risk. The other is a liquidity risk. You'll notice a term associated with each of these types of investment vehicles. And then also the opportunity cost. We always want to assess the risk versus reward and make sure that it's in line with your portfolio objectives. Now, allow me to add a little bit of context and rationale behind this investment. We don't have a crystal ball. We know that the market's going to be up and down. We just don't know when. So a key data point that I like to reference has to do with the market declines and the corrections that have taken place since 1953. We know that on average, the market has a 20% or more decline or correction about every 6 years. And the last market decline or correction took place in June of 2022. Now that's in reference to the downside. How about the upside and the recent history of the U.S. stock market? When I look at the last 6 years and look at the variety of different asset classes that are represented on this chart, and I know it's busy, but what each of these boxes represent is either real estate or commodities or international stocks or bonds, but also the U.S. stock market, which is represented here in green. And over the past 6 years, the U.S. stock market has either been the top performing asset class or the number 2 performing asset class in 5 out of the last 6 years. This leads me to believe that we are at or near all-time market highs for the market. So, given this data, as well as our history of market corrections, we're looking for ways to lock in some of these market gains, but still give ourselves opportunities moving forward. I'd like to go over 3 different examples with you. We're going to look at 3 different terms: a 4-year term, a 3.5-year term, and also a 2.5-year term. This first example comes to us from Morgan Stanley. It is a 4-year term, and it tracks the S&P Futures Index, ticker symbol SPXFP, which very closely mimics the S&P 500. This particular market-linked note protects the principal, but also gives us a participation rate of 128.5% to 133.5%. What that means is that if the market or the underlying security was up, let's say, for example, 10% each year over the next 4 years, so 40%, we would actually receive a credit of 51.4% on this investment vehicle. This is due to this enhanced participation rate. In summary, a higher leverage or participation rate means that the bank can buy more at-the-money call options, which enhances the potential return for investors if the market performs favorably. Now, that's a risk and something that the issuer, or in this case, Morgan Stanley, is participating in. We will be tracking this index, the S&P Futures Index, and then we'll receive a credit upon the maturity of this 4-year term according to the participation rate. So I've listed a few hypothetical payouts here at maturity. Let's say that that underlying index is up 60%. Well, then we would receive a credit on this investment vehicle of 77.1%. So you can see there's enhanced upside potential that comes with this 4-year term. However, one of the main reasons we're looking at this investment at this time is also for that downside protection. If this underlying index is flat or is down, then we will have a return of 0%, which means our principal is protected. and helps protect against that downside risk. So this is one example. Allow me to share with you two examples that we recently incorporated and inserted into our actively managed portfolios 1 through 6. These were issued through JP Morgan. The first one is a 32-month or 2.5-year term, and our upside is uncapped. We will receive barely over 100% of whatever that index gives us over this 2.5-year period of time. It will mature in November of 2027. Now, when we stretch that out and look at 3.6 years or 44 months, we're actually able to get 111% participation on this futures S&P index. Now, here are 3 scenarios according to this particular hypothetical or investment vehicle that we inserted on behalf of clients. Let's say that index, this S&P futures index, is up 55%. Well, because of our 111% participation rate, we will actually be credited at 61.05% in this hypothetical scenario. Now, if that underlying index is up 10% over this 44-month period, then our return would be 11.1% that's credited upon maturity. That's our upside opportunity. As for scenario 3, which protects us against the downside risk, is that if this underlying index is down 20% over this 44-month period, well, then we would break even and we would receive 100% return of our principal. This is a big reason why we are looking to implement this type of investment within our actively managed portfolios and essentially lock in some gains with these close to market all-time highs and market all-time highs that we've been experiencing. Now, when you see your statement, it's important to note that especially during that term, the value will fluctuate and can even be down. If it were to be traded prematurely and prior to its maturity date, then we would expect to do so at a discount from its initial investment value. However, part of our management is to allocate funds that we reasonably expect to hold through maturities for each of our portfolios and on behalf of clients. Now, included with this presentation in this video will include the risk considerations that are important to always be aware of with any type of investment, and this is something that we will share with you. If you have any questions regarding the risks or the individual implications for you personally, please reach out to your team here at Vander Wealth Management. We consider it an honor and a privilege to work with you and want to be a resource to you. Thank you for your time. We look forward to working with you.